Hello, everyone. Today on the Final Bar, I'm joined by Javed Mirza, technical analyst at Canaccord Genuity, coming to us from Toronto. Talk about some of the charts that are top of mind for him. A nice long-term view at the S&P 500, which I think is very warranted on a day like today, where you get a bit of distribution within the context of a fairly robust bull market move that we've been seeing. We'll talk about the potential moves in the S&P through year end into next year. Bit of a defensive play today with REITs at the top. Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using data visualization techniques to better understand price and breadth and sentiment. We'll touch on a little of all of those today. We'll talk about the overall market conditions with price indicators overall fairly strong, although today a bit of a give back in a lot of the indexes. The small cap space, particularly with the S&P 600 down 1% versus the S&P's 0.25% drop, and the cyclical trade, which overall has been emerging. Right, a lot of charts in industrials screening pretty well and making new swing highs, all at the bottom of the list today. One day does not make a trend, and that's an important distinction to make. But we'll look at how these movements that we're seeing in the short term relate to the big picture. Overall, when we're talking about this market environment, I've been describing it to people many ways like this. It's a stock picking environment, and that's kind of funny because I always feel like I describe it as a stock picking environment because I think there's usually some benefits, some upside to be had in terms of your portfolio performance by leaning into what's working and leaning away from what's not working. But particularly now we have elevated volatility, elevated uncertainty as we go through year end into next year. It could be a really good time to focus on where the opportunities are emerging. We have great guests on the show. I'm excited to talk to Javed Mirza, who's been on the show before, always does a really good job. Tomorrow on the 18th, we have Bruce Frazier, Wyckoff expert and educator, joining us on the show. Always does a great job of bringing things like point and figure charts in front of us and all of you. Coming up next week on Tuesday, the 23rd, just one guest next week, Mike Siccardi, who's going to be joining us the first time. We actually just invited Mike to start writing commentary on StockCharts.com, so I'm excited to bring him on the show next week. We'll be taking Wednesday through Friday off for the Thanksgiving holiday next week. Hope you guys all have a really good holiday and are able to celebrate safely with those around you. And then after that, we have Sean McLaughlin from All Star Charts, the option strategist there, joining us on November 30th. Also, just as a reminder, every day this week at 11 a.m. Eastern, we have a special series called Chart School, focusing on our chart list platform. 5 experts each sharing with you how they use the chart list feature on StockCharts.com. It's one of the things I use the most out of all the different features on our platform. I would encourage you to check those out. If you've missed them live at 11 a.m. every day, just go to our on-demand platform, stockchartstv.com. Let's continue on with today's market recap. So a lot of red when you're looking at the first page here on your dashboard, and these are all the equity averages. The S&P down about 0.25%, back below 4,700. Touched it just briefly, around lunchtime Eastern, but coming off and distributing just a little bit into the close, but not too far off of all-time highs to be clear. The Nasdaq composite down about 0.33%. The Nasdaq 100 actually about zero. The best performer out of the indexes we're showing here. Mid caps and small caps struggling on a relative basis, with the small cap index probably the weakest of the bunch, down just about 1%. Again, that's not much of a down day, but relative to the S&P down a little bit more. The VIX back above 17 here. So elevated volatility relative to the 15 count that we had just a little bit ago. Other asset classes here, interest rates came off today, which is one of the main reasons why you see a lot of the cyclical sectors down. That tends to line up pretty well. Value stocks tend to do better in a rising rate environment. Rising rates tend to be a little tougher on growthy sectors like consumer discretionary and technology. So lower rates today with the 10-year yield getting back to around 160, and it was up near 165 earlier today and at the close yesterday. Commodities, my guest yesterday, Jesse Felder, was talking about gold. We talked about gold stocks, the GDX. We talked about gold spot, how that relates to inflation. And you're seeing gold and silver both up today, with the GLD up almost 1%. Nearing 175. Commodities as a whole, though, broadly a little bit lower, and energy was one of the worst, actually was the worst S&P sector, with the XLE down 1.5%. Oil prices using the USO down just over 2%. Cryptocurrencies, a bit of a mixed bag here, and you have Bitcoin toying around with that 60,000 level. So right about where we closed yesterday when we were doing the show. We had Bitcoin coming off pretty good in the previous 24 hours, settling in around 60,000. We chopped around quite a bit in the last 24-hour session, but right around the same level, just above 60,000, and Ethereum around 4,250. Let's look at a couple of key charts here, and then we'll take a break. When we're looking at the S&P 500, as I've mentioned, we're potentially putting in a bit of a lower high here. Overall, let's keep a proper awareness of the long-term trend. The long-term trend is positive. The market trend model that we talk about every Friday, high across or bullish across the board, long-term, medium-term, short-term trends, overall very strong. And that's what the price behavior sort of tells you. We're going to get a little later in today's show, a segment, Banking on Breadth, where we're focused particularly on some of the breadth indicators that I think you should be aware of. But looking at the price of the S&P, the price is going higher. We're making higher highs. We're making higher lows. Now, what's happening right now is you're sort of retesting that same peak around 4,700. This is where we made our most recent all-time high at the beginning of November. We've now pulled back a bit and are retesting those levels. And the question is always, do you keep making higher highs and higher lows? When that pattern continues, the trend overall is very fine. When that pattern stops, right? When you make a lower high or you make a lower low, that's when I think you need to start revisiting the overall trend. 45.50, we remain above that level. It's hard to argue that the longer trend is anything but very positive, because that's the breakout level from early September. That's where we broke out at the end of October, and remaining above there, I would argue, makes it a pretty healthy market environment. We talked a little bit about cryptocurrencies, recently we have, and I'll just mention very quickly the chart of Bitcoin. We came off here, we made new all-time highs, touching 69,000 for the first time, nearing that 70,000 level, and then coming off. What's interesting about the chart of Bitcoin, I highlighted this recently on my YouTube channel called Market Misbehavior. We talked about this bearish divergence that we've seen in Bitcoin, higher highs in price, lower peaks in RSI. We've seen that two other times, once in February, once in August. Now, both of those times, it ended up being a triple peak. You had three higher highs with successively lower momentum. You had that same thing there in August into September. And both of those times, you had a fairly decent sell-off soon after that. I can't guarantee that it would be a similar pullback to there, but I'm always wary when you see a market going higher and the momentum is dissipating. That's not the sign of a strong and a strong uptrend with increasing building momentum. That's more of an uptrend with momentum exhaustion, indicating that the buying power pushing the price higher is starting to dissipate a little bit. What's interesting now is we're right at the level of support, right at the line in the sand. We have the lows at the end of October, right around 58,000. That's right where the 50-day moving average is. I would argue we're sort of right at that point. We're at that point where you differentiate between a brief pullback before the uptrend resumes and something deeper, more sinister, a little darker, to describe it different ways, but overall potential further downside to be had. So I think it's a really important chart to be watching right about now. I did want to mention two other charts as we're looking at the big picture charts here. I'll bring up the UUP. Now, the dollar index, we have $USD on our platform. We usually look at UUP when we're talking about the dollar, only because it's an ETF, it's fairly liquid, and it gives you a good short-term read on the sentiment behind the dollar index. And I think the story of the dollar here is stronger dollar relative to other currencies. In general, that should suggest stronger U.S. stocks versus non-U.S. stocks. That should imply stronger small caps versus large caps, although that has not necessarily been, it's not, those things don't happen in a vacuum. Those relationships are not 100% consistent. However, those are the general headwinds or tailwinds that I would be keeping in mind. So the dollar broke out in a pretty big way, and the UUP has this beautiful sort of cup and handle pattern, a big rounded bottom, a shallower pullback breaking above that level of resistance and now following through to the upside. So, certainly appears that we're in a stronger dollar environment, which we've been in for quite a while. Really, the year 2021 has been a stronger dollar. It's been in different phases of that trend, but overall really starting to emerge to the upside. And if that trend continues, I would be thinking about the implications of that sort of continued rally for some of the asset classes that I mentioned earlier. Finally, we'll talk about gold here briefly. We yesterday on the show talked in a little more detail about gold stocks, about the implications of higher gold prices with, inflationary concerns, and gold as a potential hedge of inflation. We've talked about gold many times through the course of this year, and I've usually told you not a great chart from a technical perspective. And the reason is because it's not going higher, right? In May, we talked about it potentially breaking out, getting above the 200-day, but that rally fizzled out very, very quickly. From there, the GLD has essentially gone lower. And notably, when it tried to get above this 171, 172 area, which is shaded here in pink, it failed a number of times. And I think that failed breakout in September was an important one because it told you that just the story was not positive yet. And the RSI remained in a bearish phase through that period. That has all changed in the month of November, where you see gold going to new swing highs. You're seeing gold stocks, when I'm screening for stocks making new 3-month highs, things like GOLD come up on the screen. And charts like this, rotating to the upside are a sign of accumulation. That's a sign of that you're starting to see buyers enter into this. I think on the chart of something like Barrick Gold, you see a potential head and shoulders bottoming pattern. That's a low surrounded by two higher lows. You connect that neckline. We've broken out of that pattern and gotten back above the 200-day moving average, potentially some further upside in precious metals, particularly gold and some of the gold names. So good charts to watch going forward. Let's take a quick break. We'll be back with today's guest, Javed Mirza. We'll see you in a minute. And welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down the market environment using the technical analysis toolkit. A couple quick announcements before we get to today's guest, Javed Mirza. First off, reminding you that we love to hear your questions. Feedback on the show is always welcome. Feedback on your host, super welcome and appreciated, but particularly questions that come up as you are trying to analyze your own charts. We want to help you invest more effectively, make better decisions using the power of the StockCharts platform. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our StockCharts channel. We'll gather all those questions and we'll hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Such great content every trading day, even on the weekends sometime. I was talking with one of our producers about The Pitch. We have a couple special events featuring The Pitch, which is a series of experts pitching their ideas to you. We have a couple of those coming up through the remainder of this year and our year-end review coming up in December, much more. Go to StockChartsTV.com or on your mobile device, just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Javed Mirza. Javed is the technical analyst at Canaccord Genuity, coming to us from Toronto. He's been on the show before, always does a great job of helping us put the current movements into proper context. And for that, we are very appreciative. Javed, welcome back to the show.
Perfect. Thanks so much for having me, Dave.
It's good to see you. We're starting with a good long-term view. And I describe a long-term view as going back 5 to 10 years. There's another way to describe this chart. We're looking at a quarterly chart back to the 1920s. Talk us through this picture of the S&P. What is this telling you?
Okay, perfect. So those vertical lines there, those are major market lows. And in our work, the market registers these lows typically every 3 to 5 years. So this is our cycle work. And this does a great job of preparing us for where we are within the cycle. So our cycle work said that a new cycle began December 24th, 2018. And so if these cycles last 3 to 5 years, we're getting close to the end of the cycle. So as a result of that, we're starting to get a bit cautious here, Dave.
Interesting. And it's funny how that pattern has continued, sort of narrowing around that 4-year pattern. It's been remarkably consistent, to be honest with you, when you look back over the long term. Now, also there are cycles in sentiment, which is an important topic to look at as well. Talk us through the second one.
Yeah, so this is the market cycle model. You can see this is basically what regular lay people, I would say, call the business cycle, right? So you can see the gray line is the stock market, and the dotted line there is the economy. And this is what always throws people new to investing for a curve, because the market is anticipating. So you might get strong earnings, but then the stock sells off. And essentially what's happened is the market has priced it in. So we think that we're in phase 3, as you can see here. So we're close to the market top. And as seen you've done recently in the work you've done, Dave, is you've highlighted energy has been really strong. And energy is strong late cycle in these 3 to 5 year market cycles. And so you can see that in phase 3 and 4, energy is one of the top leaders there. And you can see that at the top. And once you see that, you know you're late cycle. So we think we're starting to closely get onto the cusp of the market rolling over in the market top. And what we're watching for, really, you nailed it, is healthcare. So once healthcare starts to pick up, that for us will be a big sign. And what we're watching here is basic materials. So something like copper. Copper today had a big negative day, but what I'm watching for is it moved, I think, today below the 200-day. And for us, that's a big red flag.
It's so funny. I cringe a little bit, and you probably too do as well, when people talk about economic indicators and then using that to make assumptions about the stock market. And I always try to remind people it's really the opposite. The best leading indicator of the economy, arguably, is the stock market, right? It tells you what the conditions and what's being priced in here. Now, you talked about the potential, right, that the market may be at the later stages. We saw on the market cycle that might be the case based on leadership. Your third chart is a weekly S&P chart. How does that fit in here?
So what we're looking at here, so you can see very long term, and then we go, within those 3 to 5 year cycles. So we are in this 4-year cycle that we believe began December 24th, 2018. We think the pandemic was a black swan event, similar to the 1987 stock market crash. So what we're watching here for Dave is just signs that we're seeing exuberance. So you can see that third panel, that's investor sentiment. When it gets above that red line, it's telling you investors are very, very bullish. And conversely, the CBOE put call ratio, which I'm sure you've talked about to your guests or with your guests as well, once it gets below that red line, it's telling you there's a lot of greed. It's telling you investors are buying way more calls than puts. So when you take those two together, investors buying more calls than puts, and then also that investor sentiment is exuberant, all of those things are telling us it's time to really start playing defense. And given what we talked about the longer term cycles are, as we get deeper into the end of this year and the beginning of next year, we think at the margin or on balance, we'd shift to a more cautious stance.
It's very, very interesting, and it's quite a counterpoint to the trend that we've seen up until now. You're seeing stocks move up so quickly. When on the bottom panels here, you're showing the weekly S&P chart. You have a number of levels that are identified. What would you see that would confirm that the top is in, to for lack of a better term, but would tell you that the uptrend is sort of exhausted and that you are seeing the downside follow through? Is it things like healthcare that start to do better, which is more classic of that stage, or is it a particular level or signal on the chart of the S&P that would tell you to start really thinking cautiously?
Well, it's funny because that's where a lot of the people say technicals are art and science, and that's where we start getting into the art. So Dave, like you talked about your indicators at the start of the show, and yes, they are 100% still, we're making new highs. That's very positive, very bullish, but we're just watching for, divergences here. So this sentiment extreme. And once we start rolling over, so once we start making a series of lower highs and lower lows, and in conjunction with that, something like healthcare, and you saw real estate was the strongest sector today. So once the defensive sectors start shifting, especially on something like the RRG charts you guys show, especially on relative performance, that in our view would be the indicator that the top is in.
It's a great take. Javed, listen, it's great to see you. Really appreciate you sharing your point of view here. Stay safe and be well up there in Toronto. We'll talk to you again soon.
Thanks so much for having me, Dave.
That's Javed Mirza joining us from Toronto. He's the technical analyst at Canaccord Genuity. And I love it. The first chart, I wish we could spend an hour just talking about that first chart, because what I find particularly, with individual investors managing their portfolios, it is very easy. It is so easy to get sucked into the short-termism, the short-term movements, what I call the flickering ticks of the market. I will tell you, there's a reason when you log into your brokerage account, they don't show you a quarterly chart of the S&P talking about the long-term, growth prospects for stocks. They show you the current movements. They show you what stocks are moving, because their goal is to get you to engage. And remember that trading or investing, those words, those verbs don't imply that you have to take action all the time. Sometimes you need to pay attention to the signposts, the guideposts that the market is providing you. And I thought Joe did a great job there at the end, sharing some particular things he would be looking for, and I think that's advice very well taken. Let's continue on today's show with our next segment, Banking on Breadth. This is where we focus on breadth indicators. Now, as we talk about often, I think, for me, the macro discipline has three parts, and it starts with price, and then it goes to breadth, and then it goes to sentiment. I think that's the priority order that I've learned to be very important. So starts with price. If you know nothing else about the S&P 500, Ralph Acampora, one of my mentors, told me the first thing you need to do is look at a chart of the S&P. That will tell you much of what you need to know to understand the market environment. But then a second really important component that I've learned to rely on is market breadth, because I've seen many times, particularly at the end of a market cycle, at the end of a bull market cycle, where the market goes higher, but the breadth indicators start to deteriorate. And that often indicates that people are getting defensive, and they're going to a relatively small number of defensive names, of blue chip names that are able to keep boosting the market and propelling it a little bit higher, even though the conditions are deteriorating. And a lot of individual stocks, more risky stocks, are starting to break down. That's why the small cap to large cap ratio can be very, very helpful. That's why looking at breadth indicators like we're going to talk about here can be informative as well. We'll look at a couple measures of market breadth, and we hit on these off and on, but I thought it would be good to focus a little bit just on the breadth conditions today and where they're at. Now, as I just talked about with Javed, I think that you have to remember that overall the trend has been positive, right? That the price is going higher. That is valid. The breadth conditions have been improving as well. And if you look at the cumulative advanced decline line using the New York Stock Exchange, overall rotating in a positive direction, particularly in the last 2 months. The S&P advanced decline line has made a new high for the year here in the last week. The same is said for the mid cap advanced decline line as well. The small cap advanced decline line and the NYSE are the only ones that are just sort of testing their highs from back in June, maybe not quite following through, but overall, I think the action in the last 2 months is enough to indicate a resumption of that bullish trend for the average stock, really. So these lines going higher, these advanced decline lines going higher, suggest that over time there's more stocks closing higher than lower. And as you aggregate that daily record of stocks going higher and lower, enough are moving to the upside to indicate that the trend is still very positive. What would concern me, one of the things I might be looking for to suggest when this uptrend may be over, would be the market going higher and these advanced decline lines rotating lower. That would be a huge warning sign, and I guarantee I will not be quiet about that pattern if and when we see it. That was one of the things we had talked about back here in June, by the way. May into June, it was very concerning. We saw the market making new highs and the breadth indicators deteriorating. What happened there, it was a big change of leadership. This is when we saw the value-oriented sectors all of a sudden emerging again. This is when you saw the value sectors that had been doing very well, banks topping out in May and June, started to roll over. So when you saw the FANG trade start to reemerge, and it was really more about a rotation than a real deterioration in stock prices or in the market averages overall. The second one is looking at stocks above their moving averages, and currently it's around 75% of S&P members above their 200-day moving average. So 3 out of 4 S&P stocks in an uptrend using that 200-day as the main gauge. Above the 50-day, it's 75%. And I think what's interesting right now is at the end of September, only 25% of the S&P members were above their 50-day moving average. So literally half of the S&P 500 members from the end of September to where we're at now in about 6 weeks have gone from below their 50-day to above their 50-day, just like the S&P itself has done, being below its 50-day at the end of September and rotating back above there in mid-October. So the story of this renew, this leg higher that we've been in over the last 6 weeks is the story of a lot of individual stocks that are regaining their 50-day moving average, testing new highs, making new highs, and we'll get to that chart here in a moment, looking at the new highs. But it's worth noting 75% of S&P members above their 50-day. That remaining above 50% is sort of one of my general gauges of the market overall is pretty strong in terms of breadth. When either of these get below the 50% level, which is that pink dashed line in both cases, that's when you will hear me start to get much more cautious and talk about potential downside risk and where the opportunities may be for that. You know, we've talked a number of times how a healthy bull market environment should see an expansion in new highs. And what that means is if the S&P 500 is making new all-time highs, but it's not a lot of stocks that are doing the same, that tells you that it's not necessarily a strong move where a broad advance with a lot of names getting above their previous highs for the year. This is looking at the NYSE in the top panel there, and the bottom panel is the S&P 500. How many stocks are making a new 52-week high on every given trading day? And in general, a strong bull market phase will see a healthy number of stocks making new 52-week highs. When that would start to dissipate, that can be an area of concern. That's what you saw in September. That's what suggested that the market was pulling back, or confirmed really that the market was in a pullback phase. All of a sudden that new highs list started to dry up, and you had less and less stocks, just like the S&P itself, made a new high in early September, did not follow through to the upside. So at this point, you know, in the last couple of weeks, you've certainly seen a healthy number of stocks making new 52-week highs. I would want to see that maintain a relatively high level to confirm an upside movement. The last chart we have in very quickly here for breadth is looking at the bullish percent index. This tells you what percent of the S&P members are in a bullish point and figure phase. This is a binary indicator. You can either be in a bullish signal or a bearish signal. What was the most recent point and figure signal that you had? It just got back above 70%, which is the sign of a healthy bull market phase. When it's above 70 and goes back below, which we last saw in mid-June, that's what's called a bear alert. That's when most of the stocks are in a bullish point and figure pattern, but a number of them are starting to register sell signals. That's the sign of things starting to get a little negative with some of the individual point and figure charts. At this point, it's back to a bullish signal. So the breadth conditions overall, as I am looking at them, overall very, very strong. The reason why I think it's an important time to watch these is because when the market tends to top out, you will see these breadth indicators rotating lower. I think that's an important way to gauge a potential pullback, and if it emerges into something a little more corrective. We need to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the technology sector. The XLK made a new all-time high again today, intraday high, not a closing high, but just upticked a little bit from where we were yesterday. And overall, the trend in technology is fairly strong. What's interesting right now is you saw rates pull back a little bit, but overall, the trend in interest rates has been higher rates, right? We went from 175 on the 10-year down to around 115, and we're back around 160, 165 in the last week or so. Higher rates tend to be a headwind for the technology sector, for other growth-oriented sectors, just because basically does not imply a great, the valuation and how you're able to value their forward earnings is getting less and less ideal as rates are going higher. So it's an interesting thing to see rates going higher and to see technology performing so well, actually outperforming. I have learned that those sorts of relationships about rates and sectors and individual stocks are all fine and good, but at the end of the day, follow the charts. The charts will tell you what's working. The charts will tell you what's not. At this point, technology is outperforming, and I think it's worth an area of focus. Now, when you screen in the technology sector, it's not hard to find stocks that are breaking out to the upside. And when I was screening earlier today for my premium members at Market Misbehavior, I found a lot of semiconductors in the top, Xilinx and LRCX and ON and a number of others, too many tickers to go through. Nvidia was not on the new highs list only because it's been a bit of a range-bound chart over the last 2 weeks. Now, this has been overbought for about the last 3 to 4 weeks, just came out of that overbought region and reported earnings today after the close. So I think it's a key chart to watch whether this congestion phase that we're in, just in the short term, resolves higher or lower after this earnings report. So a really important chart to watch, I think, tomorrow and the rest of this week. Finally, Visa, the payment processors, Visa, GPN, really rotating lower. What concerns me about the chart of Visa is it's gone below its first level of support, the Fibonacci level, just going below it today. We've seen support at those previous levels before, and I'll be looking there if you see further downside potential. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Javed Mirza from Canaccord Genuity in Toronto, joining us and sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.